This video is going to look at Dover Corporation through the lens of our FastGraph research tool. FastGraph stands for Fundamental Analyzer Software Tool. In this video, we're going to look at Dover Corporation, a worldwide diversified manufacturer of industrial products. We're going to start out by looking at Dover strictly from the perspective of earnings and dividends. The orange line here is the earnings value line for Dover. As you can see, earnings have been somewhat cyclical. There was a stretch here from 2001 all the way up to the recession 2008 where they strung together some really excellent years of earnings growth. Then they faltered a little bit in 2008, and now they've subsequently been resuming their trend of earnings growth. Now we've added monthly closing stock prices, the black line here in the graph, and as you can see, stock price has pretty much followed earnings. When earnings were rising, stock price rose. When earnings fell, the stock price corrected. Then during the period where earnings rose, the stock price rose along with it. There's always going to be volatility in stock prices. Then the recession came, stock price fell, and now that we've been on a recovery, stock price is rising once again. Dover is currently trading at 16.5 times earnings. It has a dividend yield of 1.6%. And as you can see by the performance record here, they have a decent long-term record of raising their dividend every year since 1997. When you look at the compounded total annualized rate of return at Dover, you discover it's 6.9%, which correlates very closely to the 7.5% earnings growth that the company achieved over this 15-year period. The only adjustments are for modest valuation anomalies. But $100,000 would have grown to $265,000. It would have thrown off $35,877 in dividends for a compounded rate of return of 7.9%, including dividends, which outperformed the S&P 500 over this same time frame. You can see from a yield on cost, or what we like to call growth yield basis, the company's dividend has increased very nicely, and their yield has increased along with that. What we believe makes Dover Corporation attractive at these levels are that the consensus of 12 analysts reporting to First Call expect the company to grow earnings out to 2016 for the next 5 years at the rate of 14.5%. The company's within the valuation corridor. It's only one line above what we would call perfect value or fair value. And if, including dividend income, the stock could be as much as $129 a share by 12/31/2016, assuming that the company trades at 15 times earnings and the earnings growth that's being forecast here is achieved.